Emily, I mean, if earnings stay where they are, people are going to make the case that the current multiple in the market's tolerable, so to speak. It's if they collapse where they suggest that the multiple needs to come down more, which means stocks need to correct themselves even more, too. But have we just become too negative on where we are right now? Is that view still justified?
Well, markets, Scott, are certainly telling you that. It's almost as if markets are pricing in this immaculate economic cycle where somehow we avoid a recession, even with central banks around the globe implementing massive tightening here. And we just think that, you look at high yield bond spreads that are just above 400 basis points. That is remarkable given this environment. You look at the VIX today hitting its lowest level in a year. You look at the drawdown on global equities, which feels pretty garden variety at this point, with the S&P 500 down only 15%. Last week, you saw, cryptocurrencies and meme stocks getting in on the action. This is not the type of cross-asset performance that we typically see in an environment where the leading economic indicators are deeply negative. They've been negative for 5 consecutive months on a year-over-year basis. The yield curve is incredibly inverted to the tune of 71 basis points. And, you're looking at earnings estimates that are likely to come down. A typical recession sees an earnings decline of about 25%, and we're only down about 5% from the peak. So we think you need to be really, really thoughtful about where you find opportunities in an environment that's likely to get even trickier from here.
What if, Liz, the yield curve's wrong? What if people look at the yield curve and suggest, well, we're definitely having a recession.
Yeah.
Now, obviously, you don't have a recession without an inverted yield curve, but you don't always have a recession when the yield curve is inverted. It's not a given.
Correct. But it's inverted at multiple. It's inverted at multiple points, and that near-term forward spread is a really big tell. The times that we've had an inverted yield curve and no recession to follow, the inversion was shallow and brief. This is not shallow nor brief at this point. And I'm completely with Emily on a lot of those points, one of which is that you'd really have to be with your head buried in the sand, not looking at any of these indicators, not looking at the yield curve to say, we're not going to have a recession. It's at this point, there's so many things pointing in that direction. Now, if by some small chance we do avert one, it doesn't mean that we're headed into some sort of boom that calls for reckless multiple expansion either. So a day like today where we've been propped up by beta and tech and growth again and cyclicals sold off, don't let that lead you to believe that that's the environment that we're heading into. The Fed, even if they do pause, they're still going to keep rates high, right? So we end the hiking cycle maybe, but then we start the hold it high part of the cycle,
right,
which is equally painful. And to Keith's point, if we're headed for a recession in June or July, that means the market bottoms sometime between now and then.
Maybe, Keith, this is why some say it's going to be a year of nothing. That, David Kostin, for example, Goldman Sachs, says we end the year 4,000. Multiple stays where it is. That's sort of the scenario of which we're talking about, where flat feels like the new up because we didn't fall out of bed.
Well, listen, there's still going to be opportunities, right? We had 6 moves of at least 10% last year. So one of our key mantras is to remain tactical this year. You look below the market surface, we see better value in like the equal-weighted S&P making fresh relative highs. But I do think, we published a paper in mid-December called the reverse Tepper trade. And, basically what we said is either the economy is going to stay strong, which means the Fed's going to remain tight, which is not a great environment for stocks, or the economy is going to weaken, and that's going to weaken corporate profits. So we do think, the upside is somewhat limited. I think you have to look below the surface, and then you got to be, more tactical with the sectors. Just like last year, we had 100% spread between the best performing sector and the worst performing sector last year. I don't think it's going to be this extreme, this year, but I think that's where the opportunity is going to be.
Emily, do you like bonds or stocks better right now?
We think that bonds can do more heavy lifting in portfolios, especially for the first part of this year. You're looking at 4 to 5% yield in high quality bonds. That's something that we haven't been able to say for a really long time. And even if there is some volatility in rates here, we still like that income as a very competitive option. Look, we just talked about the valuation on equities. The S&P 500 just went from 15 times forward earnings all the way back up to 17 times forward earnings. So we've seen prices up, earnings estimates come down. We usually like it when the opposite of that happens. And so we want to be really, really mindful. We think earnings estimates right now are still too elevated. Analysts are calling for about 4.5% for 2023. But what's really notable to us is the bulk of that is actually expected to come in the back half of the year. So modest expectations for Q1 and Q2, and then 11.5% earnings growth right now being penciled in for Q4. We think that that's going to be really, really tough. If Keith's call is right, and I agree with a lot of what Liz said as well, that's going to be tough. It's expected to come from cyclical parts of the market. Again, you got to be really thoughtful here. Margins are coming under pressure. Top line revenue growth saved the day for earnings in 2022, especially for companies that had pricing power. The consumer was strong, 10% revenue growth last year. That's coming down to 3% in 2023. Margins are going to be under pressure. There's going to be a war on margins. Companies are going to need to navigate that.